Good morning. Welcome to IG's Early Morning Call. It's Tuesday, 7th of February. Let's take a look at the headlines as we see another central bank raise interest rates. Again, this time it's the turn of the Reserve Bank of Australia, and we've seen interest rates rising there as expected, 3.35%. But the central bank says there's more to come. We'll take a look at what's happening with the Australian dollar. BP, another oil company with more record profits in 2022. The company's also issued more share buybacks and also an increase in dividend. And late yesterday, Bed Bath & Beyond closed the session up 92%. Hopes are that bankruptcy has been avoided. Take a look at what's happening with volatility. We're up again today. And as I was saying yesterday, putting this fib on here from the highs that we had back on the 22nd of December to that swing low that we had back on the 2nd of February, all the way down at 1890. We're now trading above the 20 point. Anything above 20 represents that's a bit more volatility in the market. And for us traders, that's a good thing because we like volatility. The more the market swings, the more opportunity it gives us to make a margin and to make a profit. And it's exactly what we need to see, is that clients making profit in these markets. So that's the way that the volatility is moving. And when you get this move in volatility, we quite often see a pullback in risk assets. And that's what we saw yesterday. And you can see here in London, actually, if you look at the FTSE 100, clearly today BP is going to be one of the big movers. We'll take a look at that in just a minute. But at the moment, at 78.52 on the 24-hour markets, we are actually up on the close that we saw yesterday. But you can see right in the middle of this candle yesterday where the majority of the wick was down below underwater, which meant that the market was a lot lower than it was at the close yesterday. So we're holding on to the gains that we saw late in the session yesterday, but it's not enough to take us up on the trading day. So looking for a slightly smaller start or lower start to the European markets, not just in London. This is the German DAX, third day in a row of losses at the moment at 15,372. This is just a small retracement on some of the moves that we've seen recently, and the same can be said there on the French markets there as well, that we're seeing second day in a row of declines on the 24-hour markets, but like the London and other markets, we're off the lows that we saw yesterday at 71.55. Let's take a look at what's been happening overnight in the Asia-Pacific markets. The vast majority of the markets there trading on the way down. After the recent losses on the Hang Seng, we are seeing a small rise there today. But broadly speaking, outside of that, it's a day where we're seeing some relief or some move down in the market, I should say. You can see there it was only a fractional move lower for the Nikkei 225. The ASX 200 was down 0.5%. We'll take a look in some more detail about the context of this with that rising Australian dollar because of the interest rate decision today. More on that in just a moment. Hang fire on those markets. Let's take a look at Wall Street as at the close last night. And we saw losses across the board. And once again, it was the tech-heavy NASDAQ, which saw the worst of the losses coming through. Those strong jobs numbers out the other day, illustrating the fact that the Fed is still encouraged, I think is possibly the best way to put it, to continue to drive interest rates high. It may only be 25 basis point incremental increases, but nonetheless, anything that restricts money supply is going to, or the monetary policy is going to see some of these growth stocks on the way down. And that was what was reflected yesterday for the NASDAQ. Let's look at the 24-hour markets there. And you can see that we've got a green candle, albeit small, very narrow indeed. But indeed, yesterday, it wasn't a massive move, but it was on the way down, as we've just seen. And these markets across the board finding they're going tough at these recent high levels. Same sort of price action there on the Dow. In fact, yesterday on the Dow 24-hour markets, we did see a rise, but we're unchanged today at 33,899 on what's happening there for the Dow Industrials. Now, another central bank meeting, another interest rate rise. This time, the turn of the Australian Central Bank, the Reserve Bank of Australia, raised its cash rate by 25 basis points to 3.35%, a decade high. This was the 9th rate hike since last May, lifting rates by a total of 325 basis points. Now, the RBA reiterated that further increases would be needed. Core inflation has been higher than expected in the fourth quarter, accelerating to 6.9% from this time last year, above the central bank's previous forecast of 6.5%. Look to see what it's been doing on the Australian equity market, second day in a row of declines. And on the 24-hour markets on the IG platform, you can actually see we're pretty much at the bottom of the candle, indicating that there are no buyers at 74.99. So we dip below the 7,500 level, and the market's there looking to build on that potentially. As we see the MACD turn around, this oscillator here at the bottom, you can see clearly that we have disappeared The blue lines disappear below the red dotted line, indicating that momentum is now beginning to pick up on the downside. So I think people looking for an excuse to sell this market from the recent highs. But what's been happening is that money's been going into the Australian dollar. This is the Aussie against the US dollar. In the back end of last week, that big candle there was the rise in the US dollar because of the non-farm payroll data, and that pushed lower yesterday. Today, we got people buying back into the Aussie from those recent lows. I wouldn't necessarily say this is a screaming buy, but it's just a reversal of some of the extra activity that we've seen recently. Look at the strength of the Aussie against the euro as well, pushing up to 64.58. This is just trading within the recent band. I'm not suggesting there's anything where we're going to see any soaring change to the Australian dollar. I just want to illustrate the fact that the interest rate decision today and that intention from the Reserve Bank of Australia to continue to raise rates has seen money coming out of equities and going into the Australian dollar. This is rising against the Japanese yen. So we're up for the Aussie against a whole basket of G7 currencies following that interest rate decision and the announcement to raise rates in Australia by 25 basis points. Now, outside of that, we also got some Australian trade data where the trade surplus narrowed to 12.23 billion Aussie dollars in December, below market forecast of a 12.5 billion Aussie surplus. Exports dropped 1.4% from this time the previous month, while imports rose 1%. This means that in 2022, the Australian trade surplus increased to 139.5 billion Aussie dollars, around 20 billion higher than in 2021. Another reason, I think, to buy into the Aussie dollar. Let's move on and take a look at what's been happening here in the UK. The British Retail Consortium out overnight. According to the BRC and KPMG, UK retail sales rose 3.9% on a like-for-like basis in January, year on year. That sounds good, doesn't it? But this comes after a 6.5% rise in the month of December. Yeah, you know, December, it was back to shopping, back to an opportunity to maybe get back into something sort of feel good. So this slowdown was perhaps maybe expected. The head of retail at KPMG, Paul Martin, said, as we head into a difficult time for consumers, the short-term outlook for the retail sector remains challenging. Adding that with the last interest rate rise, utility price increases heading our way, shrinking household incomes mean we will continue to see a shift in what consumers buy and where they buy from. And what he means by this is the fact that these discretionary spends that we've been seeing, people buying things that they don't really have to buy, are going to get kicked into the long grass, I think. Let's look at what's happening with sterling. Sterling is down at 120.26 at the moment, and this discretionary spend is likely to continue to dwindle as people have to obviously spend more on heating, lighting, and also feeding their families, more importantly. So people less likely to spend on things that they don't necessarily need. And we hear an awful lot more about recycling these days than we used to, especially clothes and so forth. So that is something which I think is going to skew the numbers as we look out from here. That's where sterling is there at the moment. Just bear this price in mind for sterling as we see the markets trade just above the 120 level, because we've seen house prices hold up in January. According to the Halifax House Price Index, the index was unchanged in January compared to the previous month. The market expected a decline of 0.8%. There we have the numbers just popping up here. Year on year, the index unexpectedly rose by 1.9% against expectations of a 0.3% fall. Now, actually, despite the fact this is unchanged, this was good compared to the nationwide at the back end of last month. It said its house price index growth slowed to 1.1% in January from 2.8% in December. And it said that prices fell 0.6% in January, leaving prices 3.2% lower than their August peak. So you can see that the Halifax number, as an unchanged picture, is stronger than we saw there earlier from the nationwide. In Germany, we've got some numbers out there this morning on industrial production. This just goes to highlight further the pressures that are building, I think, within the European Union generally and in Germany specifically, falling more than anticipated by 3.1% in December month on month. Economists expecting a 0.7% decline. Now, let's shift away from some of what's happening on the economy, and I want to take a look at what's going on with some of the EP, the oil giant. It has seen a record $27.7 billion profit, lifted by a surge in energy prices since the Russian invasion of Ukraine. In the fourth quarter, underlying replacement cost profit, now this is the company's definition of net income, reached $4.8 billion compared with forecasts of $5 billion profit in the company provided a survey of analysts. So despite the fact it's a record, it wasn't as juicy, I don't think, as some had been hoping for. Ironically, these oil companies are now benefiting from a lack of investment over the last few years to pacify the green lobby, which has managed to persuade big oil to invest in renewables. Now, this has led to a lack of new oil coming onto the market, which has supported prices. I want to show you the share price chart, and I want to explain what this vertical dotted line is here. That was the day when we saw Shell come out with its record profits last week. So you can see the pressure that was built in to BP share price in the wake of that news. Since then, we've seen a new lower low, yesterday closing down at 477.9. Could we get some more pressure on the downside? Well, possibly, in which case this would then become a topping pattern. I've got these lower highs. And then if we get a lower low, again, kicking in below the lows that we saw back on the 25th of January, I think then there's more of an excuse to sell this market. MACD has crossed over in the last 24 hours, meaning the blue line's gone below the red dotted line, which means that momentum is picking up again on the downside. So let's see what happens. Technically, I think this is looking a little bit weak. I'd like to see a full candle below this blue line here, which is the 100-period moving average, which has been supporting the markets since the 2nd of August last year. So that would be an interesting break at 41.72. Now, that's only 6 pence below where we are at the moment. So that is completely doable, I think. That would be a drop of something like around about 1.3%, 1.4%. I think in the current environment, with the fact that BP has failed to reach some of the internal company forecasts of $5 billion in profit, I think that that could well spell a little bit of negativity for the stock. Fundamentally, technically, get a close below this blue line, I think then there's an opportunity here to make some money on the way down. If you are short on this going into the numbers today, your stop would go at around about the 490 pence level with a view to taking this lower. Again, not a trade recommendation, but something I think it's worth looking at in the context of the numbers we've seen out this morning from BP. Now, BNP Paribas out with numbers this morning, posting a lower than expected net profit in the fourth quarter. Net income falling by 6.7% from this time last year to 2.15 billion euros. Now, this missed the 2.37 billion mean estimate compiled by Refinitiv. So I think this is another stock that could well possibly end up seeing some declines. Let me just quickly talk you through what's happening here as well. It posted a 44% rise in FIC trading revenue to 1.09 billion euros. Estimates have been for 855. So I think that is a positive, and an 18.2% increase in revenues in its corporate investment banking division, which I think is also a positive. So we got two very different factors, I think, here building against the BNP share price. We're opening at 66.5 after, 3 days of declines. In fact, when was that? Last Friday, we saw the highest print on this stock, not seen since the 15th of February 2022. Now, in a rising interest rate environment, one would expect some parts of the bank's balance sheets and profit and loss to do very well. And I think that's really what's happened. But still, BNP Paribas has raised its 2025 targets and announced a €5 billion share buyback program in 2023. That itself is a positive. So where do we go from here? You pay your money, you take your choice, you depend on what you're going to be doing. In terms of where I think how to trade this, let me just quickly set up a couple of things for you here. If you're long on this at 60.65, I think I'd be happy putting my stop down below this area down here, which you can see has been acting as support in the last 3 or 4 weeks or so. So your stop around about the 57.70 level, opening at 60.66 if you are looking to go long on this. But if you see enough sufficient negative around this, then clearly your stop would go above here with a view to taking this lower. So you'll stop at around about the 64.50 level, taking it down to this line of support at 58.30. I think it's really very much dependent on how you view these numbers that we've seen, because there's sufficient evidence to either side on BNP Paribas to build the case for either a gain or a loss at the start of today's trade. Without further deeper analysis and further analysis of what we were expecting, I think it's difficult to say precisely which direction of travel this is going in on. US earnings out today. Now, it's nothing of any major importance. Hertz Global coming before the bell today, looking for earnings per share at 48 cents on revenues of just over 2 billion. Chipotle Mexican Grill, 8.92 on revenues of 2.23 billion. And Prudential Financial earnings per share $2.52 on revenues of 13.57. So that's what we got before the bell today. Looking out for those. None of those trades all sessions on the IG platform. What I do want to do, though, is to bring up another stock for you to show you what's going on here with Bed, Bath and Beyond. Now, look at the direction of travel we've seen here. If you look at the long-term picture, you can see that from the record highs we said back at around about $55. Yesterday, trading at 58.40 at 58.4 cents. But look at that. The stock yesterday closing up a whopping 91.33%. It seems to have managed to delay bankruptcy. Yesterday, Bed Bath & Beyond shares almost doubled after the group said it was planning to raise some $1 billion through an offering of preferred stock and warrants. It's unlikely to be able to get away with that if it thought things were going to go so sour that bankruptcy was unavoidable. So I think there's enough light at the end of what still remains a very long tunnel. Overnight, the Wall Street Journal revealed Bed Bath & Beyond had investor backing for just over a $1 billion equity raise. So things looking positive for BBBY. Yesterday, in fact, we saw a print above the 200-day moving average. The last time we had that was back in August last year. Remember this ridiculous move up that we saw in the stock? It became, at that point, one of these meme stocks, didn't it, where it was seemingly bid up ridiculously, as we now know, by those that thought that there was enough upside to go from the lows that we had then at 430. So that was an erroneous push-up, I think, there. We haven't really traded above the 100-day moving average really seriously outside of that for some time. So that, I think, was significant yesterday. Above the 200-day moving average is again another significant move, but we didn't close above that. So I'll be looking to see what sort of reaction we get further on in today's trade on this Wall Street Journal report saying that they've got investor backing for over $1 billion in equity. Let's look at what's going on in some of the other areas of the market. I want to take a look at what's going on with oil because there's been a little bit of a turnaround in the price of oil. Up for a second day today, and you can see if you look at this chart here, we got this supporting line here at 76.4% retracement, sort of roughly held. Yesterday, I was suggesting that perhaps maybe more likely to go down to the 77.65. How wrong I was on that. And of course, this is one of the things, if you're a day trader, to make sure that you have a fairly tight stop because you don't want to be caught too much the wrong side of a trade, and you want to be stopped out as soon as you possibly can to avoid making too much of a loss on a trade. But you can see the second day in a row now of gains, but we are being held up this 82.4 level, which was originally the 61.8% retracement on the way down. So that could cause a little bit of a headwind, and that coincides with the 50-period moving average as well. Little reason necessarily to take anything in any one direction or another. But I think yesterday the rise that we got was exacerbated by the operations at Turkey's oil terminal in Ceyhan. They've been halted after the tragedy yesterday that was unveiled with an earthquake that hit the region, with thousands of people now both having lost their lives tragically and also many, many thousands having difficulties with housing in the area. The facility at Ceyhan can export up to 1 million barrels of oil a day. So you can see, excuse me, that has had an impact on oil prices. Also, oil prices given a lift on hope that China demand will increase. The International Energy Agency expects half of this year's global oil demand growth to come from China. I want to switch on to US crude so that we can just show you that the same sort of price action has happened. But yesterday, look at that. We did get that total retracement, albeit brief, taking us down to that 72.63 baseline that I'd drawn on that fib there. So we've got liftoff from that point. Yesterday, Goldman Sachs raised its forecast for Chinese oil demand in 2023 by 9 million barrels a day. So there is some reason to buy into this market. How far that goes up remains to be seen. But if we get another attempt at this line of support, I suspect possibly that then may be broken and will then go down to levels either not seen since December last year or down to these lows down here, that hammer candle we had back on the 20th of December 2021, where we saw the low area there achieved at 65.80. So that's what's happening in the oil markets there at the moment. Staying on the charts, got a little bit of a buyback back into the big losses we saw at the back end of last week for the price of gold. We saw a couple of the biggest candles that we've seen in the price of gold on the way down since the middle of last year at the back end of last week. Possibly that's one of the reasons why people are thinking it's an opportunity to buy in. I'm not completely convinced we've necessarily seen the change around in that. One of the reasons why we got this drop back has been this move that we've got in the dollar basket. Yesterday, dollar basket rose above this line of nominal resistance at 103.89, and we continue to trade above there. And that rise in the dollar which itself has pushed the euro down to levels not seen in pretty much a month against the US dollar. That, going back to the gold chart, has seen gold drop. But there's a lot of things going on under the covers, and clearly there are people that believe that we've gone too far in the price of gold. Maybe it might not have necessarily gone down as far as the market really wants it to go down. We'll have to see how things go. But the next line of support is 1833, which were the lows that we had here back on the 5th of January. Just one other area, just wanted to catch up on. We spoke about this last week. Another record high for orange juice. This is New York orange juice, just to acknowledge the fact that the Hurricane Ian, which has taken out a lot of potential stock, and poor harvest generally in Florida. There's been some disease in the Florida harvest, and these prices at $235.82, benefiting the other really big orange juice market, and that's in Brazil. That's it. Back at 10:30. Do watch out for the stock of BP and BNP Paribas at the start of today's